There we go. Another weekly market recap. It's Saturday afternoon, so it's not morning for a change. And I'm particularly late in recording this one because I was planning to record it right after lunch, but then, I just procrastinated a little bit. This December, it's really getting to me. I'm in holiday mood, if you wish, and I'm I gotta admit it, I'm particularly lazy in doing whatever. But anyway, I managed to sit down and put together some thoughts or some stuff. Not a lot, honestly. So let's dive into it. So let's start out with what was the economic calendar for this week. And we got a few important pieces of news, like we got manufacturing PMI, which are still in contracting territory. Not, I mean, it's not huge, but we have been in a decent contraction phase for quite a bit of time now. It's not, you know, really a big concern because at the end of it, uh, the United States economy, it's mostly based on services. It would have been very different if we were still in the 70s where basically the situation was upside down. They were, I mean, the US were the manufacturing center of the world. So at this stage, though, a read like this, I mean, it's not cool, but it's not the most immediate danger, the way I see it. Services actually would be much more impactful, the way I see it. But again, it's just it might be a preliminary sign. Maybe you might say with a lag, the rest of the sectors will follow the manufacturing. Well, maybe, but everything comes down to assessing what type of lag you might have and how to match the two things together. So, I mean, yeah, it's there. You can watch it, but it's not really the first source of risk, or at least I wouldn't say so. Then we got Jolt's opening, downtrending yet, but again, it's one of those things where you start seeing it. It doesn't look very cool, but it at the same time, it's not a big concern yet. Although, when it comes down to Jolts, you might say that if you look at a chart like this, yeah, they basically started to come down, particularly constantly, right? And you see that oftentimes when they do come down, you get into a recession. Now, it is also true that we are still most likely um, getting rid of a lot of excess that we got throughout the pandemic, and we don't have a recession yet, nor we do have any acute signs of a recession to come. We always get the risk, right? But after all the talks about US into recession, it's something which have been going around since the end of 2023, and we never seen it yet. So as for last week videos calling tops and bottoms, it's kind of the same with recessions. Always be careful calling recessions because they might take a hell of a lot longer than what you expect. So there you go. Then what we got? Oh, ADP employment change, which was has been particularly stable throughout a good chunk of 2024, as you can see. And even for this one, we might read a little bit of a piece of an article I found. Now, it was, kind of in line with what the previous releases were. Um, the previous month number was revised lower a little bit, but overall, although even in here, you might start to see some cracks here and there, but standing to the St. Louis Fed president, Alberto Musalim, I don't know how to pronounce it. You just need to have patience because at the end of it, we are about to see a financial easing cycle. So, just hang in there, hang in there. The Fed is coming for the rescue, so to speak. It's strange to see that if you start to compare small firms or small businesses to huge firms, you see that, well, it looks like large firms actually are holding up relatively better, while medium and small are seeing uh, a decreasing jobs growth. So again, it's kind of the same parallel you could run in between when we talk about equities, right? You kind of run that parallel in between these chart and let's say big and mega caps and small caps. It's way easier for big and mega caps to maintain, financing favorable financing conditions, having access to credit, keep on growing earnings compared to what it would be for a small cap, which is why, of course, small caps tend to underperform over a long period of time. But more on that later. So, what else? We got, oh, we also got services. And again, as you can see, services are actually still in an expansion territory if you look at this index right here. So, still above the 50 line. And again, I repeat that once again, if it is about 50, it's expansion. Below 50, it's contraction, right? And services are holding up particularly good for now. And therefore, you don't have a recession in the US. You would need to have something like this. Guess what? It was 2020. Not surprising, right? So moving on, employment claims. But at this point, I'm a bit bored to look at it. It's kind of always the same. It's not really moving. So that was interesting. Non-farm payroll. They came in at and around 230K. The previous value was particularly low. Again, seasonality, a few adjustments here and there, but this is another data point where you constantly see revisions later on. So, I mean, it's good to have a look at it because at the end of it, the markets tend to move on the headline, but we could extrapolate the long-term trend of it and saying that, yeah, well, maybe if you pair it up with the job openings, right? Yeah, maybe the labor market it's not as strong as Powell is talking about. Who knows? It could be. I mean, I would say so. Like, although you might depict it as a very strong labor market, it's not. And even Jay Powell said is seeing it softening a bit, which is cool because it should help their inflation fight and bringing down CPI back to the level they would like to have it to. So, you know, at the end of it, NFP just, I mean, I honestly just look at them for the intraday type of volatility you might expect from it. But overall, with all the revisions, it's starting to lose a little bit of its efficacy. Now, over the long run, yeah, it still tells a story, but there is a lot of shady stuff going around with these data points, right? Employment rate came in at 4.2, so we are still hovering around that 4% level, which again, it's not concerning. At the end of it, Powell said, I guess it was 2, 3 months ago, that he was expecting unemployment to peak out, to stabilize at 4% and basically not going much higher than that. So I guess he would be happy to see that. I guess the real problem, and if you check historically, unemployment is always the last shoe to drop, right? But if you want to have a little bit more of a mm, leading indicator of it, you might want to check the hiring numbers, like these, for instance. You see that while layoffs are actually stable for now, look at the hires and the quits, and they are just downtrending. So basically, it looks like, and I'm not saying it for sure, but I'm just saying it looks like we are in that period of the cycle where we are not really firing people for now because we are not really seeing our profit margins being depleted or um, eroded or at least crashed. But at the same time we might not have, and I'm talking from a business perspective, right, from our company, whatever you, but at the same time we are not really hiring people because we feel like we don't need, we might not see a lot of demand of future demand on the horizon. So we don't really need to expand our labor force in order to satisfy it because we don't think it's going to come. Right? That could be the read into it. Uh, Conversely, the quits. When you see people which are not quitting, it looks like, I mean, the logic of it is I'm not quitting voluntarily because why would I quit? Well, usually you quit a job because you think you might find a better one uh, somewhere else. If people are not quitting, it's basically like maybe I don't find myself particularly well in this company, but what should I do? I mean, if I quit, I might not find another job because I see maybe friends or family members which lost their jobs and they didn't find a new one. So maybe I should stick to my actual job, although I don't like it and although I feel the paycheck it's not what I would wish for, but it is what it is. I need to stay put for now. So that's how I would read that. Okay. Now, getting rid of the economic calendar, let's move into charts and let's see what we got. Now, starting out with currencies, particularly non-eventful week like the DXY, we left it in here last weekend and we basically we find it back where it was. So it had a little bit of a bounce and it closed down the week at and around the open essentially. Still at range high of the macro range, so nothing really changed. You might say it is starting to look like a little bit of a topping formation. I don't know. Yeah, I mean, I guess like left shoulder, head, right shoulder, and now we drop back into the range. Could be because, conversely, we see that foreign currencies, of course, they are trying to extend this bounce a little bit. The euro almost did it, but then it was rejected right in here. A previous support now looks like flipped resistance, apparently, at least for now. The pound, well, actually, the pound at the end of it had a little bit more of a momentum, at least standing to the chart, right? What for the yen? Well, the yen had this rebound, particularly, well, I'm gonna say sharp, but if you compare it with what was the carry trade unwinding, it's not really that huge of a deal as for the move which was generated, and which is why you didn't see any type of impact or serious repercussions in other sectors of the financial markets. But again, it's just mimicking what the DXY is doing, of course. I would expect a little bit of a sideways action for foreign currencies and conversely for the DXY as well. Maybe it could come back down a little bit, but in an ordered fashion, not just like a crash. At least that's what I would grasp at first glance. That's it. Nothing else for currencies really. Let's check gold, which if currencies didn't move a lot, gold was even worse, right? So eventually you see that it takes a bit of time. It's been now 2 weeks since when I called for a little bit of a consolidation after this sharp move to the downside, but it looks like eventually we got into a consolidation and gold didn't really move, which is normal. I mean, at the end of it, we do understand volatility at this point. It expands and then it contracts. So it goes in a cycle, expansion, contraction, expansion, and contraction. Looks like we are now into a little bit of a contraction phase as for gold volatility. We'll see what's going to happen from here till year end, but really, there's nothing to say about it for me for now. Up until the point we stay in this range, which would be kind of like, could we draw it a little bit like this? Maybe that this range to the upside and to the downside. Would you pick what? This retest of the consolidation before the expansion higher. I would I would prefer this one to be fair. Like a little bit of a dealing range right in here. Then you got a deviation above, it falls back, it goes for a mirror trade to the other side of the range. Then it gets back into the range, gets to range high, it's rejected, gets to range low, held, and still around the midpoint of the EQ of the range. that would be the kind of long story short for this short-term consolidation we are looking at. Nothing more than that, really. Let's check oil, which for some reason was in the wrong spot. And what you know, oil closed down the week with a little bit of a dump. And again, it's just like a broken record at this point. I don't know what else to say about oil. I mean, if you've watched any of the last 2, 3 weeks, maybe 4 weeks type of assessment or analysis on oil, it is still the same, still in a dealing range and still looking heavy, looking weak. So my general overall disposition would be lower prices in the future for oil. And I got these levels marked out, which were derived from, okay, this one and these lows basically. Yeah. Will it get there? Maybe. The problem is always, yeah, but when? Right? When? It's like when moon, but in reverse. When doom for oil. Who knows, right? Just saying, it's not a bad idea to sell the reaps, maybe. Well, you could also say to long the dips, right? Yeah, it's a bit boring, I guess. At least if you swing it on a higher time frame, but I guess intraday it should be a lot of fun. I mean, this range it's particularly wide, from 66 up to 72, give or take. So I mean, intraday could be fun to trade it. Although I'm not an oil trader, so you know. Let's check the break evens a little bit. Do we have it? Yeah. What's up with them? Again, the it might be that confirming that top information I was looking at past weeks. Actually, I anticipated a little bit this type of top information. That was my logic in, I guess, last week video, maybe, or maybe 2 weeks ago. Like, yeah, the signal is not really there, but I think it's gonna manifest itself soon enough, and it looks like we kind of got it, right? I mean, admittedly, it's always not only difficult but also dangerous front running these type of signals, right? But sometimes you just have that gut feeling, and maybe you kind of get to that point, to that call, not only with that particular indicator, but you derive the conclusion from other macro stuff you're looking at. So that was me for oil, and this is me now for oil, still with the same bias. Let's have a look at Bitcoin, which is hovering around 99,500 for now. Throughout the week, it had these massive doji. That must have been brutal. I mean, for Bitcoin traders, when you get into these days where it has a range like this from 90,000 up to 104K. Hell of a range. I guess many people were scared these this Thursday. But again, I mean, I guess you should just get used to this type of volatility. Overall, in the end, it didn't really compromise any type of a structure. It didn't break below any relevant low, and still it's grinding higher a little bit. Now I do know many people are constantly asking themselves, Is this the top? Is it? We are we got there. It's topping out." Forget it. I mean, just who cares? Just you're gonna know when the top is in, right? And although it might not sound like a great help, but you don't need to know when the top is it's gonna come. If you're kind of holding it, or if you are investing in it for the long term, look at the end of it, and it's just a case in point because I was talking to a friend of mine just this morning, which was constantly asking the same stuff. Do you think this is the top? Do you think I should sell a bit because we might pull back? Look, I don't know, and you don't know either. And the best part of it is that we don't need to know. If you invest, bear in mind you don't need to catch the entire movement. Well, actually, same goes for intraday trading, but you don't need to catch the entire movement. You're more than happy, and you're gonna be way more than fine if you're able to catch even half of it, right? I mean, do you really care if you bought into here and then you had to stay like 3 months looking at it slowly grinding higher? I mean, you might be happy because you got a better entry price, but at the end of it, if it chops around for quite a bit of time, it's like at a point it starts to feel like dead money. If you look around and you see other markets which are actually reaping to the upside, now it would be much more efficient from a specific point of view for you if you could have just bought when it gets back up to into this region, because we get back above the EQ and now you might bet on a breakout of the range. I mean, I say it's much more efficient for you because your money are put into work and they basically gives you return in a much smaller period of time. So, do you want to sell now? I mean, I said to my friend, you know what? If you feel like the amount of the account or the P&L you're reading up on the screen is a little bit too much for you and you can't sleep over it, just sell a bit. Sell a bit of it. Don't cash out completely, but just, trim down the position if you're constantly stressed out about what is going to come next, right? I mean, why not? So again, it's this psychological dynamic by which everyone is fearful at the top or when the market is going higher and everyone is hopeful at the bottom. So when the market is actually collapsing, right? I mean, I guess it's normal. It's just human psychology, but you know, I'd say get a grip and just accept that this is how markets move, right? Let's have a look at yields, and this is one. Could we say this is the top confirmed? Uh, I mean, yeah, at this point, of course, it's a short-term top. I guess there is no doubt about it. I mean, you can clearly see an apex which was at this point kind of broken, almost retested in here. Same for this one. You could identify the apex into here maybe. And for the short end, uh, I think it could be this one. So, we just projected at the last shelf created before the apex or the top was actually put in. So yeah, yeah. I mean, I danced around the actual definition, but at this point, yeah, I mean, it's at least a short-term type of a top. Now, will yields collapse back down where they were, making new lows? Probably not next week. All right. And considering we are at what the market will be open back up on December the 9th, and maybe not even at year end. I mean, everything can happen, of course, but I'm still expecting a little bit of a slow grind to the downside, not a sharp move. I mean, that wouldn't be my base case. Obviously, I would be more than happy if it happened, but it is just I'm not expecting it. So, yeah. Conversely, the bonds or the ETFs on bonds, they had a little bit of a good week, right? Especially the mid duration and the long duration. Quite nice. I mean, you remember I said we might retest the area once again and then confirming it as a flip, which is basically what happened. We opened up the week in here, going higher, Then Tuesday, Wednesday pulled back, and we made a new high. So far so good. Looks okay. Still, again, could be very choppy, but you know, you you kind of like those efficient moves to the upside, or well, or the downside for what matters. They're slow, they're boring, but you know, you don't have to be worried about sharp or sudden uh, pullbacks against you, I guess. So it's just take a little bit of patience in the end. We'll keep on monitoring the situation in here every single week, but for now it looks like they want to come a little bit higher. I guess at least for the TLT, you got these high right here, which was kind of tested, maybe like you could say we tested it very lower time frame apex in here. So next level of resistance would be a little bit above it, and then you would have these it's not really what's that? It would be an overlapping gap. So that would be the external gap in here, and then you'd got the internal gap kind of like in here. So these are all levels where you could expect a little bit of a status step or resistance on the way up, assuming we get up there in the first place, of course. I'm not going to chart the other two because they're essentially the same if you understood the logic, right? Um, we talked last week about the comparison in between the yields in the US and in other countries. I took Germany as an example. Just a little bit of a curiosity. It looks like right now we got a massive problem. Now, these are the yields throughout the sovereign debt crisis back when Greece was basically going into default. And you can see how they spiked, right? Um, and of course, you see that the more the country in question was in troubles, the more the yields spiked. In here, you see, well, all of them. I guess, yeah. I mean, you got Portugal, Italy, Ireland, yeah, Greece, and so all all the pigs, and they are compared to Germany, right? Now it looks like now we got another country in the EU which might be a bit into trouble, which is France. Uh, Yields on French government bond are actually going higher. Now, in here, you can see the actual spread against the German bonds, because, of course, Germany is kind of like our benchmark. You see throughout the crisis how the German yields actually stayed particularly low. So they were considered a bit safer compared to all the rest of Europe, kinda. And of course, now you see the differential in between France and Germany. It's kind of about to pop to the upside, which of course it's not a good sign for the French government or country as a whole. Now, I guess a lot of it's particularly political driven. They got a government crisis in there right now. Uh, I heard Macron didn't resign, at least yet, but he's putting together some sort of a technical government. We'll see what comes out of it. I guess nothing fancy because I'm particularly familiar with those type of political crises because I've been living in one for the last 20 years in my country. So I do know what it means not being able to have a majority which get shit done, right? So welcome to the party, French friends. I guess now you understand how it feels, right? All right, a little bit of irony when it comes down to politics. So let's have a look at indices. Pretty good week for indices, at least the two majors, right? The NQ futures in this case and ES. Finally, NQ went for new highs. It was lagging a little bit compared to ES, which was at new highs already last week, I think. Yeah, it was on a Friday. Yeah. Um, but again, it was lagging, but it's catching up now. And of course, conversely, what you see, it's the Dow, but most importantly, the Russell 2000, which is pulling back a little bit. So you got again, once again a bit of rotation in these markets, and if you zoom out enough and you check, let's say on the weekly time frame, right? Let's say you zoom out like this, and even with short term type of as in this case, rotations or uh, temporary breaking correlations or relative strength and whatnot, you see that, as I was hinting at like 2 3 weeks ago, in my view, there is no real reason to stay in the Russell for the long term while you have the other three, which are basically outperforming it constantly. I mean, look at it. Still struggling with the highs of 2021. So, when you zoom in on a daily time frame, it might look like, oh, look, small caps. They are on a tier, small caps. You gotta be crazy not holding small caps now because now Trump has been elected. So, small caps are gonna ramp higher because Trump is all about make America great again. Yeah, I mean, uh, let's put it this way: if you compare American small caps to, I don't know, emerging market small caps or European small caps, then yeah, I mean, if you compare apple to apple, right? But if you compare them with their relative, so to speak, peers inside the United States, absolutely no reason to hold these. It doesn't make any fucking sense to me, like at all. But yet again, I guess people sometimes are just carried away by the short-term fluctuations of markets, especially throughout days like these, right? Which coincidentally was the election day, right? Yeah, November 5th and 6th. Yeah, yeah. So again, you see after the election, everything cools off a little bit, and conversely, the others took on, the position of uh, charge, so to speak. Um, Other than that, we don't really have a lot as for equities this week. I mean, they're still maintaining this uptrend, which as crazy as it might sound, I think it's not yet going into a parabolic rally. Like, if you are bullish the stock market, like, I mean, really, really bullish, um, I would understand the logic. You ain't seen nothing yet, right? This market, it's not even started to rip to the upside. Now, as I said, if you are bullish, I would accept from you this logic. Am I that bullish? No, I'm not a giga bull on anything really. Same as I'm not a giga bear on anything. I just yeah, like the less bias you can have, the better. But I don't know. It's just over the long run, yeah, of course, it pays out being bullish the stock market, but I don't like extremes, and I'm seeing a lot of exuberance right now. So psychologically, I think the market it's particularly poised for buy, but at the same time, I do remember that basically starting next week, we are getting into mutual funds distribution. And then what you're gonna have is another interesting dynamic, which would be um, what was that, portfolio rebalancing. And of course, it might be just the tiny little adjustments people do, especially money managers do with their portfolios for fiscal reasons. But what I wanted to check a little bit is this. Now, this is the equity to bond ratio. And as you can see, you got the Spiders ETF uh, ratio with the TLT. And you can see that historically, now it's pretty long period of time, like November 2002, right? Basically, we could say it is after the dot-com bust. And 22, almost 23 years of history. It's not bad. So you see that these ratio tended to come up in this channel right here. And what you get is basically the more the ratio is up, the more people are holding stocks over bonds. The more the ratio goes down, of course, the more people prefer to get back into bonds and dumping stocks. Now, of course, you can see that overall, for a long period of time, these ratios stays at and around the mean, of course. And I guess that's mostly a derivative of the 60-40 portfolio type of structure that many people tended to have over the last decade, if not 15 years, right? But what we are seeing now is that we are reaching into huge levels to the upside on this ratio. And if you look at the percentage distance from the exponential growth trend line, we are well above the second standard deviation. So, at a point, you're going to have a little bit of a mean reversion just to, this chart brings you the example of what happened last time this ratio went above the first standard deviation. There was a good amount of mean reversion, which was this one. And guess what? It was 2007, 2008. Okay. Now, again, does it have it to happen next month? No, absolutely. Actually, the red arrows suggest that this situation can go ahead and can carry on for a long period of time. Look at, I mean, it was from 2004 up to 2007/8. So this situation persist, persisted, endured. Well, it carried on for 3, 4 years before actually seeing a complete mean reversion. So just because you see something like that, it doesn't mean that you need to liquidate all your stocks tomorrow and stockpiling in bonds. So this might be an interesting aspect to monitor into the future. Now, I hinted at portfolio rebalancing type of dynamic because now that we've looked at that ratio, and now that we start to think of these money managers, asset managers, stocks, of course, overperformed bonds this year. For what matters, also in 2023, right? When you get closer to the end of the year and you see the market, which is particularly deviated from moving averages, like this is the 21, this is the 55, I guess. So it makes sense for you as an asset manager to rebalance a little bit. And since you got stuff which have underperformed compared to stuff which overperformed, the simple logic of rebalancing would suggest that you need to trim down your positions in what overperformed and increase your positions in what underperformed. So watch out for it, especially again in these 1 week, 10 days period of mutual funds distribution, because that dynamic plus the time of the year could and I want to stress that enough, it could be the catalyst for a little bit of a sharp pullback. Now again, we are talking pullbacks. I'm not saying the party's over, but let's, for example, the Nasdaq, a little bit of a pullback from here, getting back to test the previous all-time highs, which were just recently broken. Or actually, this is no, these are the Qs. Okay, would it be that bad? It would be what, a 2% type of a pullback. Same for the spiders, right? From these weak close, getting back, retesting previous all-time highs would be a 1% type of a pullback, and it would bring the overall structure back down to the exponential 29 on the daily time frame when we talk about moving averages. So again, just and presumably this is gonna grind higher with every new candle. So just a healthy pullback, paired up with all these dynamics, it could be, I wouldn't discard it, but at the same time, I wouldn't lose my sleep over it. Okay. So as for the charts, that would be it. Now, but I just wanted to hint at a tiny little thing before we go to our usual weekend schedule. Okay. And I mean our personal, our real life weekend schedule beyond markets, right? So, as I said last week in the video, everyone is there was this some sort of a top calling mania, all right? And we have checked the credit spreads as a good leading indicator for what could be a situation whereas the market could be in danger of a very drastic pullback or downturn or correction. Now, that one is good, I guess, especially when it comes down to a very long-term type of mean reverting process or long-term type of corrections. Okay, but as we well know, at the end of it, beyond the macroeconomic data and whatnot, the major factor in markets and the major driver for the markets to keep on going higher is liquidity, right? If you don't have liquidity, you don't have people able to buy this shit up and to keep on bidding and bidding. All right. So I wanted to check just briefly because the entire topic would require probably an entire week if not more of talking because there are many different stuff, many different moving parts, and many different concepts you would need to know and understand. And I'm honest, they're not very easy to grasp. And quite frankly, a little bit of a disclaimer, I don't consider myself an expert in those topics, right? But just, to scratch the surface a little bit, when you think about liquidity, and we are now focusing as usual on the US alone, you do know that both the Fed and the government itself, they got ways and they got tools to impact the liquidity, which is present in the system at the current moment in time. So they can either inject liquidity or suck liquidity out of the financial system. So I just wanted to briefly look at two or three tools that they got, and then after it, getting to what could be one good indicator to see if there is some sort of a stress from a liquidity standpoint, which could, of course, be the catalyst for a sudden and sharp market downturn. All right. Now, let's start up with one of the most discussed and debated type of tool the Fed has, which is, of course, the Fed balance sheet. Now, we can clearly see that, especially after 2019 and with the pandemic, the Fed balance sheet just skyrocketed higher. Now, we've seen it picked up, or picked out, put in the top, and now it's slowly grinding back down a little bit. So we were in massive stimulus mode, QE, student loans forgiveness, the TGA was drawn down, and more on that later. And now we are in the opposite phase. We are at least trying to revert the process a little bit. Okay, so QE here, QT now, so quantitative tightening. Um, it's for me, it is a very controversial type of a topic, the Fed balance sheet and QE, QT, whatnot, because it assumes that the Fed prints money. Now, again, not going to go into it now because it would be too long. The bottom line is the way I see it, the Fed is not printing money when it engages in QE. Simply put, the way I see it, it's a swap in reserves because we're not talking cash, I mean, usable cash, so to speak. We are talking bank reserves, which are created by the Fed and then exchanged with the commercial banking system. So, those interbank tokens are only useful inside the commercial banking system. They can move them around, they can settle using them, but it would be like, would you imagine yourself going down to the grocery shop and saying, yeah, I would like this and that. Yeah. How do you want to pay? All right, well, I got this bunch of bank reserves in my pocket. Would you accept them? And the shop owner is gonna look at you. What the fuck? I want cash. Well, what bank reserves for what? No, I live on cash. I don't live on bank reserves, right? So, I mean, it's a bit of a difficult topic, and it would be a long one. But it's just to express the fact that I don't really agree with a lot of what is discussed and talked about the Fed balance sheet and QE in general. But since we're not getting into the rabbit hole, generally speaking, the Fed used the balance sheet to supposedly, quote unquote, injecting or removing liquidity out of the system. It's pretty simple, right? If the Fed balance sheet goes up, they are injecting liquidity. If it goes down, they are subtracting liquidity. So this would be the main uh, core concept of the slide. Now, another tool the Fed has is, of course, the repo facility. uh, there is also a little bit of a piece of the article, but basically, when you say repo, if you're not really into financial markets, people are always looking at you like, repo, what? At the end of it, if you really want to oversimplify the entire shit down, it's just an overnight collateralized loan. Okay, so there are two faces or two sides of the same coin at the end of it. You got the repo and the reverse repo. So as you can read in here, the RRP, right? Now with repo, you got a treasury, right? You go to the Fed and you say, sir, please, would you accept my treasury that I got here is off the run. It's not even traded. It's just rotting on my balance sheet. Would you use it? Would you accept it if I pledge it as collateral? And then you give me money because I need money, actually. I need liquidity. And the Fed might say, yeah, 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 you can pledge your treasury. We are going to put it on our balance sheet over here. And we're going to give you, well, fuck, again, a bank reserve. And so, your balance sheet is going to be fine. It's going to be protected. And you're going to have access to a bit more of additional liquidity, again, without tipping the toe in what type of liquidity we're talking of, but generally speaking, right? And you're going to finance yourself if you need it, right? The reverse repo, it's basically the opposite phenomenon, as you can read. It's the Fed, which is going into the banking system and say, you know what, I need to get money out of your system. So I need to borrow from you to remove liquidity from your balance sheet. I got all these treasuries that I bought from the government because, of course, that's the only reason why I exist, right? So would you lend me out some quote unquote money and I will give you my treasuries as collateral. And then again, when the agreement is over, you're going to have your money back and I'm going to have my collateral back. All of these usually happens overnight. Now, of course, it can happen to whatever type of duration you attribute to it, but it's very, very used overnight. So if you check the chart, basically what you see is that when the Fed is engaging in this repo market operation, it can basically drain a lot of liquidity out of the financial system. Because if those funds, right, are actually trapped in this facility, they are not circulating in the real economy or in financial markets. And conversely, what you see is that when they draw down this facility, all this liquidity, all these funds are actually flowing back into the financial system. And then it could be whatever. It could be the financial system as for assets which are bought, or it could actually be the financial system intended as balance sheets of the commercial banking system. And then they use these funds to do whatever type of thing they want to do. They could also lend them out to someone for a profit, right? So lending activity. It depends, right? But but the bottom line is that this liquidity is available for the financial system. So this is another type of tool that the Fed might have to regulate, to fine tune a little bit, so to speak, the liquidity which is present into the system. Standing to these, it basically gives you the recap of what happened in 2020. It looks like, right, they initially overreacted with all the liquidity injections, and then they realized, well, at this rate and at this pace, we are going to see Fed funds negative. We can't allow that, so we're going to engage into these transactions in order to revert the situation a little bit and making sure that Fed funds is not going to get negative. All right, but it's basically all described into here if you want. And the last tool that we might look at in order to control the liquidity which is present to the system is, of course, the TGA. Now, this is basically, you could consider it, well, it's not, it is actually. This is the government checking account, which is held at the Fed. So, in a nutshell, if you see it going up, that means that the government is spending less. Let me rephrase because I started with the wrong foot. If you see it going up, the government is bringing in more money than what it spends. So the government brings in money how? Could be by issuing debt, right? So selling treasury, issuing treasuries, or it could be by from taxes. The government collects the taxes, and that's where they go. So if the government is collecting more in taxes and it's you issuing more treasuries and therefore collecting the cash, if it's these two aggregates are bigger than the amount of money that the government is spending into the real economy, you're going to see this account going up. If conversely, and on the opposite side, this account is taken down, it means that the government is spending more than what it receives in tax revenues and treasury issuance. And of course, you can look at it like a form of you know liquidity regulation into the system. If you are a government, you could say, you know what, I need to drain liquidity out of the system. Easy peasy. Let's spend less and let's tax more. Or shit is hitting the fan. We need to really inject money into the real economy to sustain the overall economic situation in here. Well, it's easy peasy. Let's forgive all the student loans. Let's forgive all the tax which are coming due, and at the same time, let's keep on spending into the real economy via government programs, sustaining this and that, or investing in this type of bullshit and the other. So this is how they can impact the liquidity which is present in the system. Now, getting back to the point finally, right after this prologue, if you want to check for signs of liquidity stress into the system, among these three, the one which surely will give you a clue, it's the repo market, okay? In terms of volumes and in terms of the rate which is requested to access the repo market. Let's have a look, and we need to get a little bit back in time. It was around September, it was mid-September 2019, if I remember correctly. It was around here, basically. Let's throw a little bit of a line to it. That looks like correct. September 17th, if I remember. So it would be in here, right? Okay. So let's check these two, right? You see there was kind of a good downtrend, a downturn, right? Now, throughout that period, if you check the repo market, you of course you see that there was a big spike, into repo transactions. So uh, just, if you check back 2007, 2008, we got the same type of a situation. Of course, on a different scale, but it is also true that the magnitude and the scale of the system is bigger now compared to then. So, it might just be that. Anyway, you see that when you got these spikes in the repo market, uh, that is no cool for the overall markets in general. And not only that, but there's another thing which is particularly cool. I mean, I don't know if it's cool, but let's check this one. When you see the rate at which repo transactions are actually run, you can see that if those rates are actually spiking to the upside, it's not a good situation. And if you check the date, it's the same period, September, mid-September 2019. So, you know, the point is, you could imagine like this. We are talking collateralized loan or loans because there's a lot of that. There are a lot of them, right? Picturing that out like this, it might be helpful. Let's say you got a friend, okay? It could be your neighbor or whatever, and he comes to you and says, you know what? My landlord, I'm supposed to pay the rent to my landlord tomorrow. Uh, I got a tiny little problem though. I'm gonna receive my paycheck in, you know, 48 hours. So basically 24 hours past expiration on their obligation, on his obligation in this case. So he says, you know what, could you lend me out the money that I need? And then I'm going to give the money back to you just a day after that when I receive my paycheck. So he's maybe asking you for 5,000. It could be euros, could be dollars, could be whatever. And you say, yeah, I mean, you're a friend, so I might I might lend the money out to you, but I mean, the simple fact that you are getting to this obligation coming due and you don't have the money for it, so you didn't prepare, you didn't plan your financial situation good enough to face your obligations. It's a bit iffy to me. Can you give me a little bit of a guarantee, right? And he says, "Oh, this is no problem. Look, this is my car. These are the keys. You can take it. You gave me the 5K. If I don't return you the 5K after a day, you can keep the car." So you think of it and you start saying, wait, I give him 5K. He leaves me his car, which is worth way more than 5K. So if he doesn't pay me back, I get to own the car, which is even better than the 5K I lent him out in the beginning. Why would I say no? Right? Right? I mean, it's a free risk loan at the end of it, and the conditions are particularly favorable to you. So why would you say no? Well, that's the entire point. That's what these repo agreements are. You came in with your treasuries, which are the the risk-free type of rate associated with treasuries because the government can't go bust. So you know for a fact that if you got a treasury, you're going to be paid back by the government, which has the money printer, right? So if I pledge treasuries as collateral, you would be enticed to say, yeah, it's a good form of collateral. On top of it, I'm gonna, you know, just take an haircut, like, you put up 5K worth of treasuries, and I'll give you maybe 4,900 something. I'm taking just a little bit of a spread, right? So why not? At the end of it, if you see that these rates are actually spiking, it means that the haircut or the cost of the loan, which is required to access the market, it's going to the upside. Therefore, the risk of the borrowers not being able to pay back the loan is actually increasing. And even worse, if like in September 2019, the repo market actually freeze out, it's even worse. It's basically like no one is willing to lend shit out to anyone in the system because no one trusts anyone anymore. It's like 2008 all over again, right? So if you see these repo rates spiking to the upside, or if you see repo transactions failing, or if you see the repo market getting to an halt, you do know there is an impending liquidity issue throughout the entire system, and you should pay attention to it because of this. Now, again, does it mean that every single time there is a spike in the repo market, we are going to have a 20% drawdown on the S&P? No, not necessarily, especially because, as we've looked at before, you got the Fed, which can intervene particularly quickly in these repo markets. All right, just need to step in and say, you know what, it's so cool, I'm here now. I'm going to provide what is needed to keep this market functioning. But there might be that tiny little period. It could be one day, it could be 3 days, it could be a week, right, where the markets might go high wire for a while because everything runs on liquidity. So again, since we discussed the tops, the bottoms, the credit spreads, this is another tool you could use in order to monitor liquidity conditions into markets and assessing the risk associated with markets. Closing down. This is what happened. And, not only in COVID, of course, there's not a lot of resolution in this in this image, but I guess you can read it. Uh, we are still talking secured, so collateralized overnight financing rates. So still RRP, as you can see. And you can see how they spike to the upside when you got shit hitting the fan. Sometimes they do spike, especially at quarter end, because that's a period where you got a lot of balance sheet adjustments, or window dressing type of bullshit, and you might see liquidity drying up a little bit, but up until the point it stays in between specific boundaries, it's not a huge problem. But when you see it going really high, it might be a little bit of a problem. Now, this one right here, we don't have the date, of course, but I wouldn't be surprised. It's a bit. I guess this might have been the end of the third quarter. Can't really make a lot of it. Just why would we have this spike at the end of Q3? I would have like Q1, Q2, yeah, the end of Q3. And why we didn't have such a huge spike, let's say, in the middle of Q3 in August when we got the carry trade unwinding. Oh, that's a thing I could dig a little bit deeper into. But anyway, the bottom line is if you check these rates, you might have a little bit of a grasp on what liquidity is or liquidity conditions are in the financial markets at that current moment in time. All right. So yeah, that was it. I mean, nothing fancy. Again, it was a little bit of a lazy week on my end, but wish you all a good rest of your weekend and a good Sunday. We are gonna be back next weekend, I guess. Now that I think of it, checking the calendar, let's see. We are lucky or unlucky enough that basically Christmas it's falling in between in the middle of the week, basically. So now I was thinking maybe I should post this video for Christmas. Doesn't look like this is the case, for better or worse, I guess. Right? Yeah. And with that, be nice and be cool and have a good one. Nils out.